Are you currently looking at the charts 15 hours a day, slaving your life away in front of your trading charts, hoping and praying that all the time you put into the charts trading will give you the financial freedom that you crave for? You are doing it wrong. In this video, you'll learn from a multi-six-figure prop fund funded trader exactly how to trade a maximum of 1 to 2 hours a day using this 5-minute smart money concept scalping strategy. This way, you will stop being a slave to the charts and live the life that you want to live. No BS, no fluff. I'll be revealing my entire scalping trading strategy in this video. So focus and watch till the end of the video, take down notes, and let's make some money. So the first step in my strategy is the most important, choosing a strategy to trade in. You want to choose a session that your favorite pair is active in. So if your favorite pair is gold, you want to be trading during the New York session. If your favorite pair is the Euro US dollar, then you can trade the London or the New York session. Do know that London and New York are both high volume sessions for you to trade in as compared to the Asia sessions. Now, this also depends on your lifestyle and where you live. If you live in Singapore like I do, New York will be the better choice for you, as most of you guys here have a 9 to 5 job. Doing this limits the amount of time that you spend looking at the charts, automatically increasing your time freedom. I spend 5 minutes a day marking out my charts and I trade a maximum of 2 hours waiting for the charts to give me an entry. That is realistically all the time that you need to trade effectively. The second step is going to be how you identify your trends. This will be important for you to know your directional bias for your trading session. You want to draw the highs and lows in the market on the 4-hour time frame. Why the 4-hour time frame? Because it tells me where the market wants to go on the higher time frame, giving me a higher time frame directional bias. After drawing the highs and lows on your chart, if you see higher highs and higher lows, you have yourself an uptrend. If you see lower highs and lower lows forming, you have yourself a downtrend. I only trade high probability trade ideas. So for that to happen, I need to take trades that align with my 4-hour directional bias. If the 4-hour is bearish, I'll be looking for sells on the lower time frame. And if the 4-hour is bullish, I'll be looking for buys on the lower time frame. Now, if the 4-hour is ranging, I will only sit on my hands and stay away from the market. It's that simple. For the third step, find the unmitigated order block. Now, for those of you guys here that need to learn what an order block is, let me break it down for you real quick. An order block is a price manipulation before an impulse or aggressive move happens. There are two types of order blocks, the bullish and the bearish. Now, let's look at the first example of each kind of the order block. The bullish order block is formed after an explosive move to the upside, as seen over here. The first step is to identify where the explosive move came from. The next thing that you want to do is to identify the last candle that created the lowest point in the market before exploding towards the upside. Mark this candle with a box. This will be your bullish order block. Likewise, for a bearish order block, you do the same. Identify where the impulsive bearish move came from. Highlight the last candle that created the highest point in the market before the impulse move downwards. This will be your bearish order block. The purpose of an order block, to put it simply, would be to retest the order block before continuing to trend in its intended direction. It means that for each new order block form, I expect price to come and retest before creating a higher high or lower low. So when I mentioned step 3 was to find the unmitigated order block, you will be searching for an order block that has yet to be retested. In a downtrend, you'll be finding a bearish order block, and in an uptrend, you'll be finding a bullish order block. Let's move to step number 4. Identify your fair value gaps. Some of you might need clarification as there are many names for this: imbalance, inefficiency, clean candles, and so on. This means that there are orders in the market that are left unfulfilled because price moved too fast. Let's say a sneaker store releases some limited edition shoes, and there are only 20 of them in production, each costing about $100 for simplicity's sake. The moment they release the product, it is instantly snapped up, and all 20 supply of the shoes are gone, causing the supply to be non-existent. Remember, thousands of people still want to buy this shoe at $100. Now, for those that manage to buy the shoes at retail price of $100, some of them may be scalpers and they're looking to flip this for a quick buck. So what do? So they immediately sell the shoe at a price of, let's say, $500. Now, some people are willing to buy this shoe at, say, $200. They place a bid in the market, and if they get accepted, they will get new shoes. Some are placing bids at $300, $400, or even $450, and the price keeps going. Initially, the price is going to keep pushing upwards. This is because there is an explosive demand. But once the demand for it gets to a point where the price doesn't match the demand, or it doesn't make sense because it's too expensive, the value of the shoe is going to drop. And this is where people who have placed their bids at a lower price will have their chance of purchasing the shoes from other owners. Now, let's bring it back to how it relates to trading. When price pumps too fast, there will be traders placing buy limits at prices they were before, as they are not willing to buy at such a premium price. And once demand has died down, this is when price starts to retrace and fill the unfulfilled buy limits in order to keep the market constantly moving. This is what we call market efficiency. Now you know what fair value gaps are and the reasoning behind them. How do you identify fair value gaps? It's pretty simple. On a chart, a fair value gap appears in a triple candlestick pattern when there is a large candle whose previous and subsequent candles do not fully overlap the large candle. The spaces between these 2 weeks are considered your fair value gaps. What you want to do is draw a box between the 2 wicks, and this is your newly formed fair value gap. Ideally, this is where price will come back to fill the orders, so you have a rough understanding of what the market is most likely to do. Fair value gaps can be used in conjunction with order blocks to tell us whether an order block is high probability or not. If an order block is coupled with a fair value gap, it is considered a high probability order block, and this is where I'll be personally looking to trade from. Now, before I get into 2 examples of how my strategy works in a bullish and bearish scenario, take this down. We'll use the 4-hour time frame to identify our directional bias, the 15-minute time frame to identify our unmitigated order blocks, which are order blocks that haven't been retested, and we'll use the 5-minute chart to look for entries and confirm our fair value gaps. So let's take a look at the first example. Here, the 4-hour chart shows that the GBP US dollar is trending to the downside. That is seen by the lower highs and lower lows being formed. So what we have here is a short directional bias on the 4-hour. Hop onto the 15-minute time frame and we see here that the price is still going on an uptrend. Remember, I am looking for a bearish order block to form during the London session, so we will wait until it creates one before taking any action. Once it forms, as seen over here, I mark it out and drop to the 5-minute time frame. This is where I'll be refining my order blocks to the last candle that created the high of the order block. Let's see if we find fair value gaps in the 5-minute time frame. And yes, there we have it, a large fair value gap coupled with the order block, making this a high probability area to take a short from. So I set my sell limit here with stops above the order block, targeting a 1:3 risk to reward ratio. Let's see how it plays out. And bam, TP hit in a short period of 35 minutes. Now let's take a look at the bullish example. On the 4-hour time frame on the USD CAD chart, we can see that it has been trending to the upside, and we can confirm this by drawing the highs and the lows of the 4-hour structure. We have higher highs and higher lows forming, proving it as a bullish trend. We hop onto the 15-minute time frame and look for our order blocks that still needs to be retested. Here we can see a very apparent order block that has been formed with price yet to retest the area. Once it has tapped the 15-minute order block, I then drop to the 5-minute time frame to refine my order blocks and look for the fair value gaps. Here we can see a small fair value gap formed, confirming that this is the order block that has higher probability to take a trade from. So I set my buy limit here with stops covering the low of the order block, targeting a 1:3 risk to reward ratio as usual, and let's see how it plays out. After a while, we managed to smash TP as well. In summary, it shows that this strategy works with whichever pair and session that you use to trade. All you need is 5 minutes to analyze the chart and be present during the session that you're trading in for 2 hours to make consistent money using this strategy. If you want free signals and education on top of the 14-day forex intensive that we'll be releasing real soon, join our Telegram group with the link in the description down below, and I'll see you in our next video.